The Fed just started cutting rates, which is a massive shift that will have big investment implications for both stocks and bonds, but not necessarily the obvious ones that most people expect. For example, if someone is telling you to buy core bonds right now, you should be skeptical. This is Ethan with Fundamentals of Finance. I'm a CFA Charterholder and investment professional, and today I'm going to take you through what it really means when the Fed cuts interest rates, how that has historically impacted different types of bonds, why this time might be different, and which two bond ETFs I like most in this environment. Let's start with the most common misconception. The Fed is lowering rates, so you should buy bonds. Now, logically, that makes sense. When interest rates go down, bond prices go up. The simplest way to understand why that happens is also the simplest way to understand why this may not be a good time to buy bonds this time around. Imagine you own a 10-year Treasury bond with a 4% yield. That's a bond issued by the US government, by the way. If interest rates go down to 3%, that means that a new 10-year Treasury bond would only pay 3%, but yours is still paying 4%. So that makes it more valuable, right? It's exactly the same as a new 10-year Treasury bond, but it pays more. So if someone wants to buy that bond from you, they're going to have to pay up. But here's the part most people don't understand. When the Fed lowers interest rates, they're lowering the Fed funds rate. That's the overnight rate that banks use to lend to each other. So, in our example, the value of your 4% yielding 10-year bond went up because the yield on new 10-year bonds went down. But when the Fed lowers rates, they're not lowering the 10-year rate. They're only lowering the overnight Fed funds rate. So, if they lower the Fed funds rate by 1%, but the 10-year rate stays at 4%, is your 10-year bond worth more now? No, because a new 10-year bond pays the same amount as yours. This is a concept called key rate duration, which you probably don't need to remember, but the concept is important to understand. And that's that it's the rates at the part of the yield curve where your bonds are that will impact their value, not the Fed funds rate. And interest rates at different maturities do not all move in tandem. Long-term rates are based on what is expected to happen to short-term rates over time. So, since everyone already expected the Fed to cut interest rates, it had already been priced in to longer-term rates, as you can see here from the chart. Let me show you another example. The blue line here is the day before the Fed cut interest rates, and the red line is the day after. You can see that at the very front end of the yield curve, interest rates fell a lot, since those are the only rates the Fed actually cuts. Across the rest of the yield curve, rates barely moved, and at maturities of 5 years and longer, it actually went up a little bit. So that day, you did not want to own core or long-term bonds, even though the Fed cut rates by 50 basis points. So if you think the Fed is going to keep cutting rates, does that mean you should be loading up on bonds? No, not necessarily. You should only be loading up on bonds if you think they will cut rates by more than the market thinks they will, which is what's already priced in. I'll get to my prediction of how much they'll cut rates and how I would want to invest around that at the end. But before we get there, let's make sure we understand how interest rate moves impact different types of bonds because they are definitely not all created equally. There are two main factors to consider: maturity and credit quality. When it comes to maturity, the longer term the bonds are, the less impact Fed rate cuts will have. But also, the longer term the bonds are, the more sensitive their prices will be to changes in long-term interest rates. I know that probably sounds confusing, so let's go one click deeper on each of these parts individually. Long-term bonds are less sensitive to changes in the Fed funds rate since they're further away. They're actually more impacted by forecasts of inflation since bonds pay a fixed interest rate, and you never want to have that be lower than inflation or you'll lose purchasing power over time. The Fed funds rate makes a small difference, but changing inflation expectations are actually a way more important driver of long-term interest rates. The reason why long-term bonds are more sensitive to changes in long-term interest rates is simple. Think about it. If you're locked into a bond with a higher rate for 2 years, well, that's cool, but you only get to collect that higher yield for 2 years. If you're locked into a higher rate for 20 years, Well, that can make a much bigger difference on your long-term return. The way to measure this is through a term called duration. You can see on the left that TLT, the iShares 20 plus year Treasury bond ETF, has a duration of 16.7 years. That means that if interest rates go down by 1%, TLT should go up in price by about 16.7% and vice versa. On the right, you can see that for SHY, the iShares 1 to 3 year Treasury ETF, the duration is only 1.81 years. So it's way less sensitive to changes in interest rates. This isn't a precise calculation, and it's important to remember that it's changes in the specific interest rates that will matter for each of these 20 plus year rates for TLT and 1 to 3 year rates for SHY. But in general, this is a really useful gauge of any bond or bond fund's risk to changes in interest rates. And to bring it back to the point of the video, in general, Fed funds rate changes impact long-term rates much less than short-term rates. The other important consideration is credit quality. That means how likely are you to get paid back? You should be able to find a breakdown like this one for any bond fund you look at. This one is for IUSB, the iShares Core Total Bond USD Bond Market ETF. AAA is the highest, D is the lowest, meaning the bond is already in default, and everything triple B and higher is considered investment grade, while everything double B and lower is considered junk or high yield bonds. The lower the credit quality your bonds have, the less interest rate movements will matter because what really drives their value is whether you'll be paid back or not. For example, let's say a 5-year Treasury bond pays 4%, a 5-year high-quality corporate bond from McDonald's pays 4.5%, and a 5-year risky high-yield bond pays 10%. McDonald's can't print their own money like the US government can, so its yield will be slightly higher than a Treasury, but not that much since the odds that they'll go bankrupt in the next 5 years and not be able to pay you back are still pretty low. Thus, if 5-year interest rates fall, which refers to 5-year Treasury bond interest rates, it will probably also bring down the yield on 5-year McDonald's bonds. However, for the high yield issuer, their yield is much more driven by their ability to pay you back. So changes in interest rates won't impact them very much. Instead, it's changes in the economy, or more specifically, their business prospects that will change the value of their bonds. So if interest rates are falling because inflation is falling and the economy remains strong, that's probably somewhat helpful for high yield bonds. However, if interest rates are falling because the economy is heading into a recession, that's probably a very bad environment for high yield bonds, even though interest rates are falling and that's theoretically good for bonds. It would be good for some bonds, but not all of them. That's why you can't just make simple blanket statements like, the Fed is cutting interest rates, so you should buy bonds. How much are they cutting interest rates? How much of that is already priced in? Why are they cutting interest rates? What type of bonds are you considering buying? Are they short term or long term? Are they high quality or high yield? All of those things will matter a lot for how Fed rate cuts will impact the bonds that you own or you're thinking about buying. So, how am I looking at the current situation? Well, remember, the Fed cares about two things: inflation and jobs. They cut interest rates to boost employment, and they raise interest rates to combat high inflation. Right now, inflation is falling closer to their 2% target, and the unemployment rate has been rising, so they've started cutting rates. But the market is pricing in about 200 basis points or 2% more cuts by the end of 2025. The current Fed funds range is 4.75 to 5%, and the most likely scenario priced into the market right now is that it will be 2.75 to 3% or 2% lower at the end of 2025. In my opinion, this is fairly unlikely to happen unless we get a recession. The data is currently showing that inflation might be sticky, aka hard to get all the way down to 2%, and a recession is unlikely. So, if that holds true, they will probably not cut rates by 200 basis points in the next 15 months. In fact, even they are not saying that they'll likely cut that much. They're saying 150 basis points more cuts by the end of 2025. So, if the Fed is right, and I'm right, this would not be a good time to buy core bond funds or long-term bond funds, because even if they do cut interest rates, if they just cut them by less than what's currently priced in, Intermediate and long-term interest rates could go up, and bond funds that invest there would not do well. Unless you're predicting a recession, which would likely cause them to cut rates faster and investors to rush to safety in treasuries, I think the best bang for your buck right now is in the front end of the yield curve. One, that's where you get paid the most right now. And two, that's where yields are most likely to keep coming down. My two preferred options in this area are PULS, the Prudential Ultra Short Bond ETF, and ICSH, the BlackRock Ultra Short Term Bond ETF. Even though they're both actively managed, ICSH only costs 8 basis points and POLS only costs 15 basis points. Both are basically all investment grade bonds, and both have long track records of consistently beating passive options like SHV. I would also much prefer to invest in either of these than a CD. These should give you the ability to earn slightly higher yields than money market funds and CDs, with higher but still very low risk, no lockup period, and the opportunity to earn a little bit extra return as the Fed cuts rates, regardless of what happens to longer-term rates. If you enjoyed this video, hit that like button, leave a comment with what you'd like us to cover next, and be sure to subscribe so you won't miss it. And if you want to continue the investment conversation with my partner Kyle and I, you can click the link in the description to join our Discord, which is free as I'm recording this, but may not stay that way forever. Thank you for watching, and we'll see you in the next video.